Are you here to find out how to buy a house without going through the struggle of qualifying for a traditional mortgage? Then you're in the right place. Over the last 20 years, I've bought many houses for myself and my business partners. We've primarily bought these houses for investment purposes. And with only a couple of exceptions, I'm happy to say that I've never had to go through the hassle, headache, and the high expense of qualifying for a traditional mortgage. This was not an accident. It was an intentional decision I made many years ago and part of my overall strategy to acquire investment property. And if you are thinking I had a big pot of cash or huge credit lines to buy properties with all cash, you would be wrong. But stick with me to the end of this video to understand the full context of how this all works. What you should know up front is that there is no magical pill if you choose to bypass the traditional loan qualification process. The process I explained essentially requires an entirely different mindset, some compromise, and having an alternative set of challenges. You are not going to hear me tell anyone that they can buy real estate with no money down, with bad credit, although it is certainly possible. The alternative real estate financing I'm going to cover today is called seller financing. You might have heard of it. Seller financing is not a new concept. It's actually a very old concept that has been around for nearly as long as the idea of buying and selling real estate. Seller financing is rarely talked about in mainstream media. Very few people understand it. Or if they understand it in concept, they really don't know how to implement or execute it in the real world. Banks, mortgage companies, and the real estate industry definitely won't talk about seller financing. A big reason why is that there is no financial incentive to discuss it. Many billions of dollars is made by the lending and real estate industry, convincing people into buying houses, upgrading houses, downgrading houses, and funneling them into new mortgages. Even property owners who are happy where they're living are constantly being pitched to refinance their mortgages. It's a huge multi-billion-dollar racket. I'm not a big fan of using traditional mortgages unless it's absolutely necessary. I avoid it whenever I can. With seller financing, I get more financial options than always being dependent on some bank or mortgage company. Let me be upfront and say that seller financing should be treated as a special tool in your financial toolbox when you buy real estate. It won't be the answer to every situation, but it might be a big step in the right direction and open up opportunities you've never had before. As I make this video in late 2023, it's a very tough time to buy a home, even if you have good credit. I predict it will be difficult for many people to buy properties for a while. This is why it's a good time for you to learn more about seller financing. It's all about giving you more financial options. Now, how I got into seller financing is 20 years ago when I decided I wanted to buy many investment properties. I knew there were limits of how many properties I could buy by using my own credit. This is even more difficult if you are a self-employed person like me and have fluctuating income. I've never liked the idea of bogging down my own credit report with a ton of mortgages. The first thing you should know about seller financing is that there is an art and science to it. Believe it or not, the nuts and bolts of seller financing is actually way easier to teach than the art and science part of this. Depending on your state, an experienced real estate attorney or title company will generally know how to execute the mechanics and paperwork of closing a seller finance transaction. Sometimes you have to provide some guidance on what's needed, however. Most of the hard work is in learning how to find, communicate, meet, and negotiate with property owners that might be good candidates to provide you seller financing. It's similar to getting pre-qualified for a traditional mortgage. If you can't get pre-qualified for a mortgage, you won't be able to buy a house no matter how good the price is. Likewise, if you can't find property owners that are good candidates to provide seller financing, shopping and looking at properties don't matter. I can speak for a long while about the art of finding property owners, but an easy start is to print business cards and color flyers that lets people know that you are interested in buying properties. And whatever you do, don't give out these to real estate agents. They won't be able to help you find property owners willing to provide seller financing. Real estate agents will be trying to funnel you to a traditional mortgage broker. There are numerous ways to reach and contact property owners, but the best people are those that you meet in your network and circle of influence. But don't be surprised if you do have to go outside of your network. You have to actively pursue conversations with different people who reach out to you to find out what kind of equity position they are in or what kind of mortgages they have. Keep in mind that people are not just going to volunteer this kind of information if you haven't built up some level of trust, support, and credibility. Believe it or not, the best opportunities for seller financing is when the property owner has little or no equity, or if the property owner is a few months behind in their mortgage. If a property owner has a lot of equity, there is a good chance they will want to cash some of it or all of it out, in which case they need to find a buyer willing to qualify for a traditional mortgage. However, I do find older property owners care more about receiving an income stream than a big fat cash out. They want to offload the responsibility of the property, avoid real estate agents, and want to work with somebody that they can trust and rely on. A couple years ago, a guy named Charles I knew came to me and asked if I knew anyone that was interested in buying his 3 rental homes. He was adamant he didn't want to work with any real estate agent. He asked if I knew anyone who might be interested in his rental homes. In my mind, I was interested and went to lunch to discuss what he was looking to get out of the deal. I asked a lot of questions about his situation, why he didn't want to list the property with a real estate agent, how much he wanted to sell the property for, and what kind of mortgages he had. His houses were paid off, and he didn't want to manage the properties anymore. He wanted to retire and get out of managing properties altogether. It wasn't a priority that he got all his equity, or whether he got monthly payments, but he did want to feel good about the arrangement. After some thought, I passed on the houses because I didn't want to get tied down with this particular project. I was in the midst of a transition. Buying property is easy, but then the hard work begins to turn it around and get them performing. But if I had wanted to buy a home to live in, I had 3 to choose from. Or I could have bought all 3 of them with Charles willing to sell or finance all of them. However, I ended up referring this to a landlord friend named Jack. I tried to put Charles and Jack together. However, Jack took an impersonal approach and wanted to transact using a spreadsheet and submit a traditional real estate offer. I didn't care for that approach. I knew Charles for a number of years. He was in his late 70s, and I knew it would put him off. I found that when you speak to seniors, especially those that don't need the money, they want a softer, more personal approach. They want to feel good about the people they deal with. They want to be assured they will be taken care of and you will stay in contact with them. Ultimately, Jack didn't buy any of the 3 properties. Jack kept making it about the hard offer, but I advised Jack to sit and spend time with Charles to talk through it. Jack kept focusing on the numbers and insisted on it and had little willingness to sit with Charles. I was frustrated because I've dealt with seniors and I've done many deals of this kind. They want and need assurances. They want the personal touch. They need people that understand their stage of life and what they want to pass it on to their children. During my initial conversation with Charles, I covered many topics and the big picture that went beyond the 3 houses. I explained how the seller finance transactions would fit in the big picture at his age. Unfortunately, my friend Jack did not make any attempts to meet Charles and discuss anything beyond the 3 houses, and the seller finance deal died right there. Charles did come back to me again to see if I was interested in the 3 houses. I told him my time was already committed to other projects. If I had pursued it, I would have sat with him to figure out a deal. He knew from his prior experiences with me that I was knowledgeable in these kinds of deals. I thought it was a lost opportunity for both parties. Charles eventually did sell or finance the properties to other buyers. Speaking of lost opportunities, my cat Jaggy wants you to swipe that like button to help spread this video. And if you hit that subscribe button, he will get a special treat. With every seller finance purchase I've made, I've always taken a softer sit-down approach to discuss important issues to understand the seller's situation, where they come from, what they do, where they are right now, and where they intend to go. But with traditional real estate transactions with real estate agents, it's all about the hard numbers and the hard offer. With seller finance transactions, it's all about creating trust and rapport with the seller. You do this by meeting with them and having honest conversations. Believe it or not, I usually have most seller finance discussions right in the comfort of their home. In early meetings, I rarely bring contracts or forms with me. I only bring a notepad and a calculator. I inspect and do a walkthrough of their home. I ask them to show me their mortgage documents. I connect with them on a personal level and discuss their issues and concerns. I explain how we work, what we can do, and what we cannot do. I explain how we use a local real estate attorney who does all the paperwork. I never use the word contract or other technical terms unless I have to. I use layman terms when I speak wherever possible. I explain and give assurances of how we are incentivized to succeed and how we will be putting our financial resources into the property and take care of their monthly mortgage payments. The only time they have to meet us outside of their home is at the real estate attorney's office for the closing. The closing for a seller finance transaction at our real estate attorney's office is treated with the same respect as a closing with a traditional mortgage. We keep everything on the up and up. At the closing, they get a set of paperwork in a nice folder, and they hand the keys over to us. I tell this story to explain that unlike the traditional mortgage process, seller finance transactions are all about connecting with the property owner as the seller. If a property owner likes, trusts, and believes you, they will be open to seller financing to you. It happens more often than most people realize. People don't advertise that they do these kinds of transactions. They are done quietly and privately between a buyer and a seller. To get a seller finance property, you will have to speak to many property owners. Please note that I say speak with property owners, not sellers. I say this because there are many property owners who aren't selling their home that would be interested if the right offer and solution came to them. Many property owners quietly suffer with their mortgages and property, not knowing how to get themselves out of their situations. They know that their situation is not a good fit for a real estate agent, or they simply don't trust them. A group of property owners that are good candidates for seller financing are ones with little or no equity in their property. They want out of their mortgage and would consider someone taking over their mortgage payments. Property owners who have little or no equity are good candidates for you to have discussions with. Another group of property owners that are good candidates to communicate with are owners of properties that need a fair amount of work. Their properties are simply not retail ready. They could have a dead central air system that the owner cannot afford to replace. There might be a leak in the roof that they can't afford to replace. They have worn carpet or flooring, which is too expensive to replace. Or the house has simply become outdated and the owners cannot afford to update or modernize the house. These property owners have limited options because they can't make their property retail ready. I've bought houses from owners who were behind in their mortgages and didn't want their homes foreclosed on. They don't have sufficient time to properly prepare and sell their homes, and they need a fast sale. They sold it to us because we were the only people they knew willing to take on their as-is situation. We bring the mortgages current after the deed is signed over to us at the closing table. At this point, I would like to touch upon two seller finance techniques. Up to now, I have used the term seller financing. However, seller financing is a broad term that includes different financing techniques. The specific seller finance technique that I like the most as a buyer is the subject to mortgage. I wrote a book about it many years ago. It's available on Amazon as a Kindle book for less than $10 if you want to know more about it. The short explanation of a subject to mortgage is where you, as the buyer, take over a seller's existing mortgage. You don't formally assume the mortgage, and you don't have direct liability for the mortgage. But if you don't take your responsibility seriously, the house could be lost to foreclosure and the seller's credit would be damaged. If property owners are behind in their mortgage payments, you have to bring it current. That is why you should have access to some financial resources for these situations. Any late fees, penalties, and attorney's fees, you will have to take responsibility for them. Although you don't have to qualify to take over a mortgage, you do have to have access to financial resources to meet the financial responsibilities. The concept of a subject to mortgage freaks out a lot of people and triggers all kinds of negative reactions. Some might scream, it's illegal, but that is factually untrue because nearly every subject to transaction I've been part of was closed with an experienced real estate attorney. Also, there is actually a line item on a HUD-1 settlement statement for subject to mortgage transactions. No respectable or reputable real estate attorney will risk their law license to close illegal transactions. Most people, including real estate agents, don't know that a subject to mortgage even shows up in real estate licensing course materials. It's only a paragraph or two that students miss, and it gets lost in the hundreds of pages of text material. But it's there. Some people might scream that there is an acceleration clause, the due on sale clause, and that the bank or mortgage will shut you down if they exercise it. But that comes from people who don't really understand how mortgages work in the real world. Banks and mortgage companies are not in the business of creating or causing foreclosures. Banks and mortgage companies are in the business of collecting mortgage payments, not foreclosing on mortgage accounts that's current and in good standing. Other people might ask, what happens if the mortgage doesn't get paid? I would tell people it would be stupid for me to take over a mortgage, reinstate the mortgage, prep up the property, and then simply abandon the mortgage. I'm in the business of making money, not losing money, or ruining people's credit. There's also the matter of my business reputation. I have every incentive to make sure any mortgage I get involved with gets paid and continues to get paid. For the record, a business partner and I have been paying on subject to mortgages for nearly 20 years. Many of these mortgages have been paid off or nearly going to be paid off. No bank or mortgage company has ever freaked out or been upset with us. And for the people who are still unnerved by subject to mortgages, then it's simple. Just don't do them, stay away from them. It's as simple as that. Another seller finance technique I like to use is buying property with a wraparound mortgage. There are a couple of types of wraparound mortgages. The traditional wraparound mortgage, as covered by most real estate books, presumes there is equity in the property. The seller extends terms to the buyer on a wraparound mortgage that exceed the terms of the underlying mortgage. For example, let's say a seller has a $200,000 30-year mortgage at a 5% interest rate that has been paid down to $150,000. The monthly payments with PITI are $1,600. The terms of a wraparound mortgage could be a $250,000 25-year mortgage at a 7% rate. The monthly PITI would be approximately $2,100 in this example. The seller earns a $500 per month positive cash flow due to the mortgage interest rate spread in addition to the difference in the principal amount. This is the traditional way of structuring a wraparound mortgage. However, I've also bought property on a mirror wrap, which you structure the wraparound mortgage to essentially mirror the exact terms as the underlying mortgage. This is ideal for situations where the property has little or no equity. I've also bought property with a purchase money mortgage in a situation where the owner owns the property free and clear. Because there is no underlying mortgage to deal with, the buyer and the seller can freely set mortgage terms such as the interest rate and terms of mortgage without the constraints of an underlying mortgage. If you do decide to embark on a path to seek out seller financing to purchase property, you should understand these options. Here are things you should know about seller financing based on my 20 years of experience with this. The first thing you should know is that seller finance transactions are often found and created through many meetings and negotiations. Trust, rapport, reputation, and credibility matters. Sellers have to believe and trust you. The second thing you should know is that it can take you a year or more before you find the right seller and situation that would be a good fit for a seller finance transaction. Seller financing requires you to keep an eye on the prize for an extended period of time. For most people, you are looking for that one good opportunity to make the entire effort worthwhile. The third thing you should know is that your chances of doing a seller finance transaction will be better in smaller cities than larger cities. I tend to prefer second-tier cities. I don't want to say that you can't find seller finance deals in larger metro areas, but there is a lot more competition and the real estate market tends to be hotter. The slower the market, the smaller the market, the easier it will be to do a seller finance transaction. The fourth thing you should know is that even if a property owner is willing to sell you with seller financing, it doesn't mean it's financially justifiable. If you can't afford it, seller financing doesn't matter. I've passed up on many deals where sellers were almost begging for us to take over their mortgage payments. I passed them up because they didn't make any financial sense. You don't want to ruin your credibility and reputation by buying a property that you will later lose because you couldn't afford to make the payments. This includes factoring any repair or maintenance costs to bring it up to suitable, livable standards. Thank you for watching. Don't forget to hit the like and subscribe button, and I will see you in my next video.